has been so many events. All right. There has been so many events going on, so it's good to finally be able to get back on track again. And today we're going to be learning about stock selection for the defensive investors. So I think previous meetings we've introduced what the defensive investor is and what is a stock selections, and we've also gone through financial statements. So if you guys don't remember some of that, please revisit. We have notes and everything uploaded, and recently we've been doing good with videos as well, so you can look back on the uploaded video. And how have you guys been? I know it's been like a really long time, but how have you guys been? Sorry, I didn't catch that. Oh, Fiona's rejoining because I think her thing is not working. It shows that she's still joining. Oh, okay. So obviously we're going to wait 4 more minutes until 2:05 to get officially started. But yes, so if you forget any of the information or vocabulary, please let me know and I will remind us what that is. And of course, if it's a whole entire lesson, you can go back and look. Yes, and Ella said in the comment section that there's a lot of exams coming up. I feel that same for us. Both Amy and I, we both have 11 IB exams coming up, which is absolutely insane. But I think we will all get through it just fine, and just pray for the best and try our best and not regret, not studying. Yeah, final push. Wait, so how many of you guys are seniors? I know we have a couple of juniors going to college next year, but I can see the comment section. Oh, you can? Yeah. So if anyone answers, just oh, some people are not from the US, so it doesn't work the same. Okay, well, oh, right. I committed to UNC, so it's a college in North Carolina, and I'll be studying business, international business there, so that's very exciting. For US schools, we end in May, I think, so we end in May, and we have like 1 and a tiny bit more months left, so that'll be really fun. And oh, go ahead. Okay, so from the comment section, everyone have a different rule in their country. So in the UK, Sweden, and then Zara's a junior, but she's 18. So I think she'll be applying to college next year. It's a very long process, but I'm sure we will all be successful in it. As Amy said, she's going to the University of North Carolina at Chapel Hill, which is the top-ranked public school in the US. I'm still deciding between my options, so I'm not sure where I'm going to college yet, but definitely there are some great options open for both of us to decide on. All right, 2 more minutes before we get started. I'm not sure if you guys can catch my audio well enough. I'm going through her account. Oh, it shows that your thing has a green square. We saw we both. No, it's just you. Oh, okay, perfect. All right, so I think I'm just gonna get started. There's 2 minutes. I think we can get started. So today, obviously, we're talking about stock selection. So choosing the right components for your portfolio. So your portfolio is the whole thing, and every puzzle piece in there is very important. And today we're going to be talking about how to select that, how Graham, the author of The Intelligent Investor, recommends us to do those evaluation. And at the end, we will be talking about the costs and benefits of predictions and the value of the stock and to what extent can we use these strategies. All right, so before we get started, the defensive investor is someone who wants to play it safe. They don't have a lot of money to risk, so they want every single penny of their money to be worth it and to earn money in the stock market. So they're playing it safe, no significant amount of risk, and just trying to reinvest in their money instead of setting it in the bank and let it deflate. All right, so let's get started. Next slide, please. Oh, okay, so when choosing an issue, there are 6 quality and quantity type of standards that we need to offer, we need to be following. And when you do your fundamental analysis, I know we have gone through a lot of different strategies, but when you're selecting for specific stocks, these are the 6 quality and quantitative criteria that you should follow to guarantee a long-term return. And Graham, the author, feels that we should consider when we're choosing issues, because all of these metrics and standards are in tune with what the defensive investor may want. So we will address the stock selection right now. And if you think you're an enterprising investor, so you are willing to put a lot of money in there and you're willing to risk, we will be talking about that one next time. All right, so I'll begin to give more detail on these 6 criteria. Okay, so the first one is the adequate size of the enterprise. So the goal is to exclude all small companies, which may be subject to more average circumstances. So for example, they might be an industrial field, which is something that's new and have a lot of different small public companies in. So while there are opportunities when investing in enterprises that don't meet the size requirements, those companies do not meet the risk factors for a defensive investor. And right here, we're trying to eliminate all risk, so we have to find an adequate size for the enterprise we're investing in. So there's 3 bullet points of logic here. So first, the firm should have less than 100 million in annual sales for an industrial company. So what this means is that they should have at least 100 million, if that makes sense. Yeah, at least 100 million in annual sales from the industrial company, because this is a sales industry and there are a bunch of industrial companies out there. And then the second one is no less than 50 million in total assets for a public utility. So this is another type of stock. So right now we talk about industrial, we talk about utility, right? So utility, they can't not be less than 50 million in total assets. And this you can all find in the financial statement that we went through, I think, 2 events ago. So all public companies are legally required to post their financial statement online. So you can just do a quick search and it'll be up there. So this book, obviously, it was written in the 70s. So the last bullet point was in the commentary that I found. So the commentary says that companies should also have a total market value of greater than 2 billion. So there aren't a lot of companies like this. So we're talking about the top 5% companies. And right now, if we're trying to play it safe, or if we're trying to be a good defensive investor, we have to look at their total market value. And you can just easily search this information up online. All right, so that is the part with sufficient size of the enterprise. And the next one is that we have to have a sufficiently strong financial condition. So how we check this is for industrial, for example, if we're going back to the previous one, the current assets should be at least twice the current liability. So I think we talked about this in the very beginning when we were introducing different terms. So this one has to be a 2-to-1 ratio. So current assets to current liabilities. And this is all this in the financial statement. It's very easily accessible. So why do we want more assets and liability? Because we want to know that they have enough cash, they have enough current assets to pay off whatever liability they have without declaring bankruptcy. Because if they declare bankruptcy, then we will lose all the money we invest, right? And that is not the goal of a defensive investor. So you have to make sure that there's at least 2-to-1 ratio or more. And then the next point we want to mention is that long-term debt should not exceed net current assets, working capital. So right here, the net current assets is similar to the upper one, but net includes more financial amounts. So net is the total amount of current assets. And long-term debt it's also listed in the first section of the financial statement, and it cannot. So long-term debt is different from current liabilities because long-term debt is not current. It is within a very long time, so say 5 years, that the company have to pay back instead of currently. So what you want to make sure that they're currently able to pay the long-term back as well. So that's the second bullet point. It's quite similar, but it's a little different. And then the next one is just that for public utilities, again, the debt should not exceed twice the stock equity at book value. So what book value means is what is present on the financial statement, not what is shown on a ticker or a brokerage, because that is the stock value of the company. That is not the book value. And then for this section, having sufficiently strong financial condition, obviously this book is written a while ago. So in the commentary, the commenter, his last name is Zweig, adds that a defensive investor can always prosper by looking patiently and calmly through the bear of the market. So you really have to analyze every single part of the financial statement. You can't really jump in and say, oh my goodness, it has been going low this whole time. I think it might be going up. Because for a defensive investor, you really don't want to risk that. And Zweig says that you should be calm and patient when doing your fundamental analysis. And if you build a diversified basket of stocks whose current assets are at least double their current liabilities and whose long-term debt does not exceed the working capital, you should end up with a group of conservatively financed companies with plenty of staying power. So right here, when we're talking about building a nice puzzle in the very beginning, that every single piece counts, this is what it means. You have to make sure that every stock in your portfolio follows the 2-to-1 ratio stability test. Yeah, and the next one we'll be talking about earning stability. So for number 3 is earning stability. What we're saying here is that we really want to be seeing at least some earnings for the common stock in each of the past 10 years. So we have to affirm this test still works, right? So this one was written a while ago. So I have some data for you guys. So in 2002, 86% of all companies in the S&P 500 matched their earning consistency criteria. That's a very, very high data. So the S&P 500 is the top 500 most valued companies in the stock market. So if you can see that 86% of the companies met their earnings consistency criteria, then you can trust the company, the earnings stability. So at least some earnings for the common stock in each of the past 10 years. And how you evaluate this is you pull up their ticker on, say, Yahoo Finance or anywhere, right? You look at each year, and every year has to be higher than the previous one because they have to have earning stability. And their stock has to be increasing instead of, going downhill the whole time. Because if in the past 10 years it has been going down, you can't expect it to go up because that is a very long period of time. All right. So that's number 2, earning stability. Number 3, I mean. And the next one, we're going to have to look at dividend records. So for a lot of stocks and bonds, when you invest in there, you will become part of the dividend receiver. So for example, Apple, they pay you dividends, right? So that was a dividend is. So it's very similar with earning stability. We're looking for a proven track record here. So for the defensive investor, it is recommended that we find uninterrupted dividend payments for at least the past 20 years. So we do recognize that there hasn't a lot of new companies. So tech companies, they haven't been around for 20 years, right? So how would you evaluate that? Right here, we have to go back to the point where we are the defensive investor and we want to play it safe. So we're trying to look at the uninterrupted dividend payments for the past 20 years. And so here are some facts. So as of 2003, 71% of the S&P 500 had paid a dividend. So that's good news. Majority of the top 500 performing companies are paying dividends, and also no fewer than 250 companies have paid a dividend for at least 20 years in a row. So being able to pay dividends in 20 years in a row is a very impressive company performance. That means that they already have a very developed leadership team that is well prepared for what's coming up in the future. So when you learn a bit about finance, dividends is basically, let's say when you buy a share, you own the company a little bit, and however much share you own, however much the company's profit is yours because you own the company a little bit. Now, dividend amount is paid amount per share, right? And that amount is decided based off of the board of directors at the company. You all learned that when you learned about the finance. I believe we taught a course in that before. However, Amy presented the statistics saying, okay, there's this many company in the last several years, or this many company. This just shows that even if you are a defensive investor and you're not willing to play risky games, you still have a lot of options to choose from. Yes, thank you, Rena, for that input. So yes, so the last point addresses the point about how, oh, there aren't a lot of companies that has been around for say 20 plus years that we can look at dividends and consistency, right? It's very hard to find. Well, there is data that at least there's 57 companies that have raised their dividends at least 25 consecutive years. That is insane. So when you think about building your portfolio, is it possible to have 57 companies? Probably not. So there are a lot of options out there, but for the defensive investor, if we want to make choices that are in our favor, we really have to dig into the fundamental analysis part. And that's what we're learning here. All right. Perfect. So let me know if you have any questions, stop me anytime, okay? So number 5 is the earnings growth. So this one is that we have to make sure there's a minimum of increase of at least 1/3 per share in the past 10 years. So this one's very similar to earnings stability, but this one we're trying to see how much growth are we looking at? How much of the percentage of the previous year's growth are we looking at, right? So Graham actually offered us an equation to evaluate this. So in the past 10 years, we're going to use a 3-year averages for the beginning and the end tails. So for example, if you look from past 10 years, say 2014 to 2024, right? You'll look 2014, 2015, and 16, average of those prices, and then take the average of the past 3 years. So 2022, 2023, and 2024. That's how you see if the average of those two have an average of 33% higher, then yes, this is a good stock to invest in. So we're able to make a risk adjustment here and find that in the long term, if we put our money in here and not have to do day trade, we know that this company is going to grow because it grew at least 1/3. And Zwig in his commentary, so most recent commentary, he said that if you are trying to play even safer, you can adjust the sorting companies for a higher rate to something like 40 or 50% earning growth over the span, which will come out to 4% and 5% growth per year, right? So you really have to look at year is just a time frame. You can do 9 months or whatever. So I'm just using 10 years for an example, and that's what Graham is offering, right? So you really have to look at stability in earnings growth, because as a defensive investor, I can't be sitting in front of the screen, say 8 hours a day and do day trade, right? So that's the long-term thing we're considering. All right. So number 6 and the last one is just moderate PE ratio. So we've learned this before. The equation for PE ratio is current price over average earnings of a certain amount of time. And right here, what Graham suggests is that the current price should not be 15 times more than the average earnings of the past 3 years. So right here, the denominator, he put the average earning of the past 3 years. under the current price. And for some reason on Wall Street, as we discussed before, it is common to find that the value by dividing the stock's current price by the next year's earnings, and most often these rates are wrong. So it is more reliable to follow Graham's equation. So on Wall Street, what they're doing is that current price divided by the estimated amount of earnings next year. So if you pull up a financial statement, so say 2024 quarter 1 financial statement, towards the bottom they will say estimated earnings for quarter 3 quarter 4 of 2024, which hasn't happened yet, right? But the PE ratio says you should divide the current price by whatever you're going to earn predicted. So often that is not very reliable because that does not account into any, say, natural disasters or events or social norms that shift sale industries. So that is something we cannot rely. And the adjusted equation is shown here, which is the current price divided by average earnings of the past 3 years to provide reliability for the defensive investor. Okay, so does anyone have any questions about this 6 points? You explained pretty well. Okay, perfect. So if you guys don't have any questions, I'm going to be showing an example about stock evaluation. So right here, we have a question. So which companies meet the requirements we set previously, right? So previously, remember we said that the growth have to be at least a certain percentage. It was around 50%, 55%, 50%, right? And right here, we can see that out of all of these, so obviously this is in the 1970s because when this book was written, but we can see that there are only 5 companies who meet the requirements we set. And again, we see that we can find all this information or calculate information from publications like the S&P Stocks Guide and other online stock aggregation tools. So this is a equation of the price earnings, past 3 years, their book value, which is on the financial statement, not the ticker, not the ticker, and then current assets over current liabilities and the ratio. And so this is a list of all the things we're looking at. But when we're looking cumulatively, you can only just look at the last line, right? It is very clear that the company Swift has a significantly low percentage compared to what we're looking for. And right here, if we're trying to play it safe, we can add all the other companies in our portfolio for long-term growth. Okay, next, please. Yes, so selectivity for the defensive investor. And right here, I want to comment on the prediction versus protection method because as we talked about, we sometimes over evaluate a lot of companies, and that's not something we want to do for the defensive investor. And we want to choose the best possible stocks to incorporate into our portfolios, right? So picks that retain our principles and grow. So it is offered that if analysts are all agreeing on one stock issue at the best, that the efficient markets hypothesis could then warrant that the value issue no longer is the value of the stock, if that makes sense. So if I rephrase that is, if everyone thinks something is good, it will be overvalued because one thing is good, right? Perpetuation will make the stock price go up a lot more, and the value is going to be way more higher than the actual, the cost is going to be way more higher than the actual value or the worth of the stock. So when Amy mentioned the efficient market hypothesis, have you guys heard of that before? That's one of the most famous hypotheses in the stock market. Okay, so the efficient market hypothesis is basically the saying that at any point in time, we have perfectly, is it the efficient market hypothesis, right, Amy? That's what you said? So basically the hypothesis states that in a perfectly efficient market, no one is able to predict what the stock market will be tomorrow. So it's assuming that at every point in time, the stock market is unpredictable for the next specific time period. That's basically what the hypothesis is. To add on. Yeah, thank you for explaining that. I skipped over that very important part. So yes, that is the prediction. And I think it's very adequate to assume that we don't know what's going to happen in the stock market next. But with all of these evaluation and looking at their history, it is very, very optimistic that in the long term, we will have a portfolio with growth. So let's move away from individual stocks, individual companies, individual within society, because the stock market is not affected by any singular individual. So when we build our portfolio, we have to follow that same pattern and have a bunch of safe stocks together so that your portfolio can grow bigger without being affected by a singular thing, if that makes sense. All right, so right now we're going to be talking about the prediction versus protection method. So as we know, we don't want to be buying the hopes of future prospects, and rather we want to buy the knowledge of real value, right? So future prospects means that just basically what I said about overvaluation. Everyone thinks something's going to go up, so it's going to be overvalued, and when you put your money in there, it's just going to collapse because everyone loses hope along with you. So that's basically why we don't trust future prospects. And we have to lay our two approaches that are often used and emphasized by the pitfall of any investment firms that focus on method of prediction. So right here, the predictive method is where future prospects, management, and the human element, which is qualitative, are taken into account. So we're going to predict, okay, so next year, fertility rate is going to decrease by 0.5%, right? And we're going to account that into the baby utilities industry. So we're not going to invest in that. So that's basically your rationale, right? That's a predictive approach. So right here, we speculated the management and humane element of this stock market future, right? And it is very, very highly speculative, where everything's going in our head. Nothing is actually happening. We predict it's going to happen. We don't really have a lot of data that supports the slight decrease in fertility rate is going to affect the stock market of a certain industry, right? So it gives little to no regard of current prices, and it really doesn't help defensive investors to put money in anywhere. So in contrast, the protective approach, being quantitative and statistical approach, emphasize a measurable relationship. So we have to see a certain correlation between why we're buying it and the prices, right? So the selling price and the earnings, assets, dividends, etc. We have to see at least some type of correlation with existing book numbers and the current price on the stock market. So not only does the protective method protect our principal as a defensive investor, it also gives us a real understanding of the strengths and weaknesses of the enterprise that we may become owners of. And of course, what does it mean to buy a stock? You're buying a certain share of the company. You become a part owner, maybe not a lot, maybe you own say 0.00001% of the company, but you're still part of the owner. And if the company do well, you do well, right? So we always have to keep in mind that where we put our money is where we value the company that we're investing our own time as an owner. So that also goes into business and a lot of other fields that we can talk about another time. And Graham right here offers a quote saying that we're not willing to accept the prospects and promises of the future as compensation for a lack of sufficient value in hand. So this one, he addresses the predictive method for the defensive investor. We cannot accept the prospects and the promises of the future because we don't know what has happened. And as the efficient, what's it called? Market hypothesis. Yeah, efficient market hypothesis says we can't predict anything. So we have to see a correlation between history and now to see how the company is going to perform in the future. In the history, we're looking back 10 years, 20 years. We are not able to risk our money with recent utility companies, recent tech companies, even if it seems promising. So that's basically the lesson today. And I know it's a short lesson, but I hope you guys learned something. Do you guys have any questions? I know we also have an announcement for the book club, which we will have an email out later, but do you guys have any questions?